All right, welcome back. So in this video, we're going to talk about some different ways that deals are structured. So to make this effective, I'm going to use an example, right? This is sort of an example deal that we might put together here at Significant. So I'm going to walk you through two parts. So right now I want you to focus really on this top part right here. This is sort of the waterfall structure, right? And as a reminder for those that maybe don't remember, waterfall is a way of describing what's called a promote for the sponsors and investors, and it explains really how we're going to share the profits from the project. Okay, and so I'll walk you through each of these sections. So right now we've got GPs, which are us, general partners, and then LPs, which would be you, but limited partners, and those are passive investors in the deal, right? So the guys that are running the deals are the GPs, and the LPs are the passive investors. So this is saying in a deal, in this particular example, we've got 100% of the cash flows are going to the LP investors, 100%. So all the cash flows that was left over after paying the mortgage, that's key, right? You've got your rent collections that come in, you have your expenses, whatever left over is your NOI. Below that, you pay your mortgage. What's left over from that is the cash flow, essentially. And so if there's money left over for cash flow, we're going to give 100% of that cash flow to LP investors until they get to an 8% internal rate of return, 8% IRR, right? And then zero goes to GPs. And then at hurdle two here, right? After 8% up to 10, there's this split that's happening. Remember, maybe in the previous video I mentioned this kind of siphoning off. Well, 10% of those cash of the cash flows after 8% go to the GPs. That's where we start participating in some of the upside in the deal, right? And you're getting 90% in this example, up until 10% internal rate of return on your invested capital. And then there's a third hurdle. So after 10%, we start sharing that 25-75, right? So up to 16%. So be between 10.01 up to 16% goes to a 25-75 split, predominantly going to LPs. And then above 16%, we're going to split that half and half. So half goes to us, half goes to you. And this is part of the reason why we kind of backload these promote splits towards the higher end of the range, because we want to be incentivized to get to this point as fast as possible, so that now we're participating in that cash flow stream along with our investors, and we're making our investors a healthy return on their money. So let's walk through an actual deal. That's just sort of the structure, right? So 2 minutes to go through that. Let's go through an actual deal. So in this is an example, right, of $100,000 investment. And by the way, I should probably point out, we also, the GPs themselves, our money are almost always in the deal itself. So our money is also treated like this. So our cash that we put in the deal as an investment goes to this hurdle as well. It's not until we get to this kind of points over here where we're getting extra from our role as a sponsor in the deal. I just want to be clear about that. So we put 100 grand in the deal. And what this is walking through here is each of the years, right? Year zero is the kind of start point, year one, year two, and all the way and so forth. And how much, what the sum cash flows would be to that investor through each of the hurdles, right? So they put 100 grand in it's going to take, in this case, 5 years for them to get through really all of these hurdle points, because there's not enough cash flow in year one, in year two, in year three, and year four to get to a point where we've satisfied this 8% along the way. So in year one, there's about 1% coming out. In year two, year two, there's 1%. In year three, this is where there's a refinance event. So we go back to the bank, we've increased the value of the property tremendously, and we're able to return, in this case, $93,000 or 93% of an investor's capital back to them at that point in time. And that's great, because now you can take that at $93,791 and go reinvest that in some other deal. And you're still part of this deal, but your cash is now out going to work somewhere else. And that's really one of the beautiful parts about multifamily investing. So, but at this point, meaning us, the sponsors here, haven't gone through all the different hurdles yet. So you're still there, and there isn't really enough other cash flow in that particular year to kind of get you there. In year four, we start all over again. We're still trying to get you through 8%. Each year, you've got to get to 8%. Otherwise, we don't participate. You get paid first, at least you're 8%. So in year four, there's 3% that gets paid. And then in year 5, when we sell, that's where we start going through all the different hurdle and waterfall metrics. So there's enough, there's $31,000 of money that comes to you that satisfies this 0 to 8%. And then there's $9,000, $9,700 that come out between 8 and 10. And then 35,000 between 10 and 16, and then 25,000 after 16%. So that's your respective. We have your 8%, your 10%, your 25% share of I'm sorry, your 90%. Yeah, I'm looking at these numbers. You're getting your full 8% there, your 90% of cash flows, your 75% of cash flows, your 50% of cash flows, and that culminates in $100,000 of total cash flows there, right? So this works out to be a 19% IRR deal. You're getting a 2x of your money. That's the equity multiple of 2x looks like, and that's a doubling of your money in 5 years, right? Plus the tax benefits that we talked about maybe earlier on, where in this particular deal we were doing a cost segregation study, and I think in this deal we were offering anywhere from 70 to 80% of your invested capital as depreciation in year 1. So you put 100 grand in, you're getting $75,000, $80,000 of depreciation in that particular year, and that's sort of it. So I hope that was helpful to kind of walk through some of the deal structures that we do. I guess the only thing I would kind of add here is this isn't the default structure that we have. Each deal has a unique characteristic about it. There's different elements that make up the business plan, different elements that make up the timing, and different elements that make up the cash flow potential. But we generally strive to have some sort of capital event, refinance event within the first 3 years. The sooner the better, but sometimes you just can't control those things. And then we're holding the deal for an overall period of 3 to 5, sometimes 6 or 7 years, depending on the deal, where it's located, all that no nonsense. So those are some of the elements, and then that also dictates what these hurdles will look like. We're always striving to get our investors at least 16% plus internal rate of return on their money, right? We try to get more if we can, but 16 is a great number. Let me know what questions you've got. Thanks for watching this video. I'll see you next.